Nick Twidale from FP Markets. So the Aussie's taking a bit of a hit there. This is always such a volatile series, Nick. Your initial thoughts?
It seems like a bit of both. So it's a slight drop for the Aussie, really. But we've got an improvement in the unemployment rate, but not as great increase in the overall employment numbers. So I think we're not going to see too much of a massive reaction in the Aussie dollar from that data. The headline will be that 3.6% that we see on the news tonight when we come in. I think that's probably a little bit more positive. Might see a few more Tonka trucks coming out for Christmas.
Yeah.
I think, you've got to probably, more for the Aussie traders, we look back to what we heard from Governor Michelle Bullock earlier in the week, and she was a touch more hawkish. So I think it probably will give us a few opportunities to maybe look to pull a few Aussies in. Not necessarily against the dollar again, that's probably still king, as you just said, but maybe on the crosses. So interesting data. I think when we start to break it down, and we'll really look at that headline figure on the unemployment. The fact that the part-time's outstripping the full-time is interesting. It probably shows about a bit of constriction in the economy.
It kind of just points to what is happening in the economy overall. And Danny Akuga and I were talking about this earlier, that we've been coming in, we don't normally work full-time, but we've been coming in the last couple of weeks full-time, and we were absolutely blown away on Tuesday by the coffee queue. It was like everybody was in the city, but today you go in, you get your coffee straight away. So is this a hybrid situation of what we're seeing in the economy, people still working from home, or is it that more people since the pandemic are going, you know what, I don't want to work 5 days a week?
I think it's a bit of both, and strangely enough, I really noticed that on Tuesday as well. And I was coming in over the pandemic, so I've gone from seeing the same 12 people in our sector of the city every day and not being able to get a coffee to Tuesday, I think, was the highlight. It was very strange. I think we're seeing a bit of everything going on. I speak to a lot of different sectors in the market as well, and that hybrid role is being pulled back, and there's a lot of demand to get people into the office, but there's still a pushback from candidates that they're sort of saying, well, I want to work from home now. So the new norm is probably going to come along with economic constraints, and it does feel like more people coming into the city. But once again, I've just come up the lift here in Barangaroo, and you look across the way to the next tower, and there's not that many people sitting at desks.
No, indeed. All right, let's talk a little bit more about what we're seeing in the currency markets, because I was just talking to Jonathan about that as well. And certainly when you look at the escalation in the Middle East, the rising bond yields, so many aspects, I mean, the US economy continuing to look really strong, I guess, or resilient, that just continues to see the dollar in focus.
It does, and I've been pretty disappointed with the appreciation in the dollar. If you look at, I know you were talking earlier about gold. Gold's done over, I think, 8.5% in the last 8 days. If you look at the euro, you look at dollar yen, you look at Aussie as well, the falls haven't been as dramatic as you would expect. If you'd have asked us 2 weeks ago and told us the situation in Israel and the Middle East now, you'd probably be looking for Aussie a hell of a lot lower, and euro lower, and especially where the US yields are as well. So all those combination of factors, I think we're about to see currency markets kick off again, and it probably will be a catalyst out of the Middle East. We've got enough excuses to buy dollars out the US at the moment. We've got stronger data this week as well. Retail sales popped up a little bit. There's a little bit of a mixed message coming from the Fed again. I mean, I've lost count of how many members of Fed are speaking this week. They must be earning a fortune on that speaking tour. Well, fair enough. But I think there's still a hawkish leaning on that side of things. We're now talking obviously not November, maybe December, probably January. I think there's still only really good reasons to buy the dollar. What we really need is a massive, I suppose, peace initiative in the Middle East. I don't think that's going to come anytime soon.
Yeah, sadly, it doesn't seem like it, particularly with this tit for tat over who bombed the hospital. The gold move is interesting too. I mean, that's really on the back of this safe haven play. It's
been huge, yeah, and it's obviously it's one of the main things you turn to as a trader. In this situation, you go, right, I'm going to buy gold. But it's just strange how the correlations between a lot of the currencies in particular have not fallen into place. So the gold market, and I think some of the gold market reaction has been because it had such a big fall before. So on that drop down from like 1950 down to 1810, that was kind of inexplicable as well. It felt like there were some big players getting out some sizable portfolios, and they were looking to use that sort of dollar yield. But now you've got gold racing back to the top side because of that. But oil's not really raced to the top side either. It has moved higher, but I thought maybe we'd be through 100 by now. And once again, currency, so it's a bit of a weird market that we're experiencing, and it does feel it's just going to, it literally just takes that little tinderbox to go, and things are really
let's talk about oil, because I was talking about that with Jonathan, and he was saying, look, this break of 92.50 could send it to a new and higher range. Somebody yesterday, and I apologise, I've forgotten who it was, but they said $150 a barrel oil.
I think it was JP Morgan was throwing out that. And it's always great to get a headline.
Yeah, get a headline, and then I forget who it is, and they don't get the headline.
But it makes a lot of, let's claim it for me, it makes a lot of sense if this situation in the Middle East escalates, and it escalates into, probably the worst situation that we're looking at, and a lot more countries get involved. The US gets dragged into it, Russia gets dragged into it, obviously Iran. I think that's when you're looking at $150 a barrel. But hopefully we don't go that far. Hopefully things calm down, and then you'll see it pull back. But I certainly don't think, given what we were seeing earlier in the year from OPEC and OPEC Plus and the production cuts that we've got, $100 is quite easily attainable, especially in the current situation. And I'm kind of a little bit surprised, given the move we've seen in gold, that we haven't seen that move in oil as well.
Okay, well, what else is on your focus in terms of some of the crosses? I think last time we spoke about the Swissy and, obviously just looking like another safe haven again.
Yeah, I think so. Safe haven trades have got to be in focus. I think the Swiss, that's got massive opportunity to increase against the euro and the dollar. Yen, I'm looking at very, very carefully. I think the yen's the one that we're going to get some real fireworks in.
Speculation of intervention, right? So what did you read into those comments? Because it kind of sounded like they weren't really saying that they didn't intervene.
No, I think there was some kind of intervention. Now, whether it was verbal, whether it was checking rates, from the move that we saw, I would say there's definitely rate checking going on, at least, and maybe a few touches in the market. I think they've been fairly happy with what's happened. They may be re-evaluating things. We've got this 150 as a line in the sand now, but maybe they're going to move it a little bit higher, given the safe haven aspects we've seen on some of that. And there's that chart. I mean, look at it. You can see that's that high. There should be a run up to 155 if it breaks through there. It went through 150, and we got those checks. I think they might let it go a little bit further, but I think they will come in if we do break through those levels. So it's when and if, as usual, with everything in these sort of circumstances.
Still quite an extraordinary move, what you've seen, though, from the third quarter of last year. So in the last 12 months compared to what we were seeing at the end or the beginning of 2022.
Yeah, it's a big move, but it does reflect those interest rate differentials and the move we've seen in the US and the move we've seen in the US Treasuries. So I think it's fair on that. It's been erratic and it's been fairly volatile at times. And now we're clearly hitting, that chart probably shows it very well, that we've gone into this sort of range trading pattern. We could call it 147, 150. It does feel like something's going to happen. And like I said, in a few of the currencies, it feels like we are going to get a big move one way or the other. They've sort of been sitting on the back step for the last couple of weeks.
Yeah. Guys, let's just have a look again at what's happening in the Aussie since we have had this data released. I just do want to recap. I know it's on the bottom of the screen there, but employment coming in at 6.7 thousand for September total, but full-time employment falling by almost 40,000, and there was quite a big dip coming through in the Aussie dollar. I'll get it up on my screen in case we can't. There we go. So continuing to have that little bit of a ratchet. What do you think, Nick, towards the latter part of the day, and particularly as we start to focus in on the US session, and I guess the Aussie moves too on the wake of the China data yesterday?
I mean, I think we've got to take into account there's always a little bit of smoke and mirrors that sometimes comes with Chinese data. It looked relatively positive. I think, we had people talking about the Belt and Road schemes and everything that we've got from China recently. I think it's being largely discounted, to be honest, by most of the guys that are sitting in the market. It will be outstripped by what we've, certainly not this Australian data, but what we're seeing in the US and what we saw in the US overnight and what's coming up in the Middle East over the next couple of days. So it seems a bit wrong because we trade Aussie so hard on Chinese numbers and Chinese data. But my feeling and talking to some, I'm going to call them seasoned professionals, but they're well-seasoned professionals, some of the guys, they did largely discount what we got out of China yesterday, which is, it's not great, but that's how the market received it, I think.